Hey folks, stick around. We are talking options and the volatility as an asset class, of which Chicago and Miami is now the future of. So, who knows, who trades options? Anybody trade options? There we go. All right, 1, 2, 3. Okay. Well, we're going to have a discussion that basically I think is very much technological in nature, financial infrastructure, but really about how the trading world has morphed, developed, and changed, and I think probably improved for the better over the course of the last, we'll call it 5 years, really as things have accelerated. My name is Oliver Rennick. I'm the host of Chicago Future of Finance, founder of a company called Narrative Capital. I'm a TV guy. Basically, right now, I have a TV show that is at the SIBO in Chicago, and we are focusing on how these properties have really shifted the market. There's also a story about advisors in Chicago that's very important as more and more of the financial world has embraced options. What'd you guys do with your COVID stimulus checks if you got one? Or let's say they give you $2,000, right? We're gonna get $2,000 apparently. Fresh new stimmy check coming. What are you gonna do with that? You're gonna plug it right into the market, baby. Exactly. So basically, since COVID, things have changed quite dramatically. And so this panel is about putting that into perspective for those that, are, if you're involved, you're gonna be familiar with some of these concepts. If you're not, there's a whole world that is, I think, quite fascinating, that is a must know now in terms of understanding financial markets and thinking about how technology is enabling new ways to trade. Some of that is very much, a technological thing that I think is built largely in Chicago. I think everybody has Chicago roots of some form or another here. Brent Kochuba to my left is the founder of Spot Gamma and a regular on my show as well. We are talking about how options flows kind of have changed the way you think about the market. If everybody's trading a new asset class, then there's going to be new ramifications of that. Spot Gamma is a platform that enables you to really track all of this in real time. I think it's the best visualization there is of how options move within the market and the sort of mechanisms and feedback that they provide traders, the opportunities that they provide traders. So we talk on a daily basis about figuring out where not just volatility is moving, but volatility of volatility. And that's really kind of the advent of a good bit of what we're going to talk about, which is the next level. Options are derivatives, but there's also second derivatives. And that's when you really start to get interesting, because you create a lot of opportunity. If you think about how people trade stuff, like when you heard about GameStop and how people move quickly on these fast shifts in markets, there's new opportunity for folks to trade these. Matt Cashman, also, you were on what, day one of my show, Matt?
Am I what?
You were on day one of my show or day two?
I was on I believe it might have been day one.
I think day one. Matt Cashman is a fixture in Chicago finance and an educator, I think, a leader on the front, principal of investor education at the OCC, Options Clearing Corp, which when you're talking about infrastructure changes and technology, the OCC being a major key part of that, because if you go to the pit in Chicago, if you go to the SIBO pit, the options trading floor, all that stuff, the action that you see behind you, guys throwing up their arms, it's the only place in the world that still happens. And that's because it requires a real effort to ensure that things are running smoothly. You fire off a trade, you put on risk, you want to make sure that you're getting what you signed up for. And a lot of that infrastructure can be seen basically live, which is also plugged for the show. Watch it, because it's the best background there is. Only place where people are still trading and shouting. Anthony Rousseau comes from that background. He's a VP of product strategy at TradeStation, trading platform that is pioneering new forms of AI integration into trading. I think that's a big part of this because when you think about all the technology that really has shifted and adapted, if you want to keep up, I think it's basically options. You have to understand options if you're going to understand the market. You have to understand the infrastructure and the market structure behind it. and you have to understand AI as well. I'll start, I think Matt probably makes sense to start with you, because when we think about the kind of ground being set here, what do you think people need to most know about the infrastructure, the pipes? You're kind of an expert on the pipes and the plumbing. So let's start there. That seems like a good place to begin.
Yeah, I appreciate that. The pipes are obviously very important. I talk all the time about the fact that it's not the sexiest part of option trading, obviously, just like the pipes in your house are not the sexiest part of your house. The curb appeal comes from how it looks from the outside in, but that's not always the best parts of the house. So OCC obviously is the largest clearing corporation of options of listed options in the entire world. This year, it looks like we're going to clear north of 15 billion contracts, which is a kind of absurd number when you think about what we were dealing with 10 years ago. Oftentimes when I give presentations, I always talk about 2008 as this kind of seminal year. I was trading options at the time, and at the end of the year, it was 3.7 billion contracts after what was theoretically the most volatile thing any of us had ever seen up until that point. And now we're dealing with a year where 70 million contracts are trading on a daily basis. It's a lot. It's a lot of contracts. So, and the interesting part about it, I think, from my perspective, is that this ecosystem continues to function in a pretty smooth, stable, and safe way on a daily basis, even when you're dealing with volumes that, if I had told you were going to be the normal case on a daily basis 10 years ago, you would have told me I was crazy, right? And I think that speaks to the foundation that's been built in the centralized clearing facility that OCC provides. I do think that there are, many of the things that both of these guys are going to talk about from a technological perspective are things that are very forward focused and are going to change the landscape. From our perspective at OCC and where I work, OIC really, which is the educational layer inside it, our job is to essentially make sure that we are still there as the technology is ramping forward and pushing us forward, to make sure that the educational layer that we provide is still there and available to people no matter what. And so I think that's our challenge, is to make sure that we're evolving with the landscape. We're a very large organization that tends to, because of the fact that it's a highly regulated organization, tends to look kind of backward instead of forward sometimes. And that's not the organization, it's just the function of how it works when you're regulated that highly. And so that, I think, is the challenge, is to continue to evolve in a landscape where people like these guys are pushing that boundary, and to make sure that we're there in a safe and secure way along the way.
It's what's great about financial markets is they are, in my mind, a real embodiment of nature. So evolution is very real. If you're in a school and each grade is getting smarter every year, if you want to perform at the top of that class, right, you got to outperform. If you want to get into college and the SAT scores are going up, you got to beat them. And I think that's a good place to bring you in, Brent, because, let's say a decade ago, education, if I kind of just come from, Chicago and that kind of background, the first level was, all right, you buy a put, you buy a call. You're speculating in the direction of that. Most people, if you look in SIBO, a lot of what's happening behind you is people are generating income. They're selling options. They're creating insurance. They're creating protection for the stocks they own. But then that's kind of the level one. The level two is really all right, well, if you're going to have to stay one step ahead of the curve, literally, an option is a derivative. It's a rate of change, but then there's a rate of change of the rate of change. And that's really, I think, kind of the core of where people are finding alpha, and they use spot gamma to try and find that alpha. So Brent, kind of tell me about how that sort of level of education has informed kind of who you're creating your product for and what they're using it for.
Yeah, as the options volumes grow, we just had a record 110 million contracts, I think, on the 10th. And we keep setting new records, even at a faster pace. So you have a massive options market, and the impact of that options market continues to sort of exert more force. And we can statistically prove these things now. Our platform, for example, shows you all these data linkages between how these options positions are flowing into and out of the market, and then related to that, how much the market is moving. So not just so much in terms of a direction, but also volatility, or how much movement there is. And what's interesting to me about that is that people who are not focused on the options market want to have a narrative as to why there's so much volatility or why prices are moving in a certain way, and they're not watching these flows. And so what happens is they will misconstrue the importance of an event, for example, because of the amount of volatility that we're seeing or the lack of volatility we're seeing. They say, oh, this wasn't an important data point, where what's happening now is the flows that are so dominant and so in control of what's happening. If you think about systematic option strategies, if you think about there are now more ETFs than there are single stocks, for example, these sort of flows related to options trading are again becoming really the dog that people say, as opposed to the tail that wags the dog. So our platform is really dedicated on informing people as to not just where the market is positioned right now, but what is likely to happen, right? If then type statements. If the shutdown ends, how much vol will come off and how much impact will that have to the market, for example? How much do traders really care about a CPI data print or about an earnings call, right? We can tell that by how options are priced, for example. What is the market expecting? There was a lot of conversations about the prediction markets here. Well, the options market is a prediction market itself. It's pricing in all sorts of events all the time with incredible probability insights, and that can be really informative to traders. And so the big thing we're trying to do here is we say, look, even if you don't trade options, you have to watch the options market. And I can make the case that you, as a fiduciary, are being irresponsible by not watching the options market because these flows are moving markets with such frequency.
That's where the title of this panel, which uses the phrase volatility as an asset class, becomes really important. Because if you kind of think about asset classes, the traditional understanding, my career started at Bloomberg. When you learn the asset classes, it's stocks, it's bonds, and all those are the big ones. There's commodities. There's futures, but then there's crypto, which is a new one. Volatility itself kind of ignores the underlying. Obviously, we have to pay attention to the underlying, but volatility as an asset class tells us that because there's so much now being built around derivatives, that we have to think about this as like anything else that we gauge the weather, right? If I'm covering the market for a TV show, I have to watch these different asset classes, try and tell people what the weather's like in the market. If you don't know how to talk about volatility as part of the weather, then you're not going to know if it's inclement or not. Tell me, Anthony, and your guys' user base and how people are using TradeStation, how they kind of think about volatility as an asset class, and how you as a product manager have had to develop to make sure you stay on the cutting edge of that curve where people are trading volatility.
Yeah, I think it's a great point. And I also just like to piggyback before I answer that question on kind of what Matt was saying and Brent. Like, number one, like the market structure has changed over the past decade. So you wonder why, how are we getting all these flows? Like, how is that happening? Well, it's the level of the playing field is starting to get flattened by two reasons. One is the cost, right? The cost to actually participate. And then the second is functionality, right? The greater functionality that we develop as product managers and platforms and technology providers, we're leveling the playing field for the average person that doesn't, necessarily have access to institutional grade technology. Now at TradeStation, we've been building technology for decades, trying to provide institutional grade technology to provide you that edge in the market. But essentially, all technology right now is converging. You can pretty much go anywhere and get pretty much most of the same views and most of the same functionality. There's small improvements here and there. What's going to change, though, is really how we interact with the market. And what allows us to do that is more education, right? And if you have more education, you can drive better outcomes. At the end of the day, for me to sit there and spend time with Matt takes his time and my time. What we're doing at TradeStation is we're starting to level the playing field by adding a different component to your interaction with the market, and that is starting to interact with AI and trading. We recently just launched a protocol that works with our API. MCP works with our API, effectively using Claude to be able to provide you the ability to actually have a conversational interaction with an LLM, Anthropic in this scenario, to be able to start to actually develop trading strategies, risk awareness, visuals. This brings your trading to a whole new level and starts to actually democratize the sophistication of how options is really traded today. like really options has really been an institutional asset class that's been really dominated by institutions, and the flows are really all data driven, right? But how can you actually get all that data? You need to have teams that are actually, you know, sifting through that data, providing you that information to make decisions, or you have to have systems. We're building those systems. Well, now I can actually do that with an LLM and interact with that LLM, and it can provide me anything I need to know within minutes, where it would take me weeks and months previously. So we're kind of like really changing the way that customers actually really ideate, validate, and execute their workflow on a day-to-day basis when trading.
I'm a bit of a nerd. I grew up, my favorite video games were like the cyberpunk style, like futuristic kind of Matrix type stuff. One of them is a game called Deus Ex, and the whole point of the game is like you keep upgrading your body with these different enhancements, you know, robotic arms, eyes, all this stuff. It kind of seems like what you're describing, Anthony, is like, obviously is not physical, but a version of that where people can augment their knowledge, their understanding, their trading now with something that is able to learn faster than them. So why not, right? Are there any dangers in that? You know, when we talk cyberpunk type stuff, there's always a pushback of, well, what if we go too far too fast?
Yeah, I think there definitely is, and I think there's going to be such regulatory kind of oversight in this area. Essentially, I mean, it's right now it's on the cutting edge. I think at TradeStation we like to be on the cutting edge of product and be able to drive innovation to our customers and to the marketplace. That's really changing how we think about the market. But essentially, you know, when you think about the guardrails around this, you're effectively right. You're going to train a system that essentially can eventually become a interaction in the market that is independent of you, without you having controls around that, which we do provide controls around for customers and for our interactions. You effectively could have a new participant in the market without you even recognizing and realizing it in the future. So that's true.
To your point about also kind of flattening the playing field, Matt, to come back is, I think a lot of people, when they think about how much options trading is happening, when they think about the retail options boom in particular, there's a natural cynicism that comes with it. Especially, I mean, to some extent, I shared some of that during COVID when it was very clear that people were just piling stimulus checks in the market, right? And things started to look pretty bubbly. It's okay, are people going to be able to withstand this? Well, they have. The evidence tells us. Look at Robinhood earnings. Look at people have done well for themselves. Retail's been ahead at so many turns. And I think a lot of that is due to education, but also because a lot of what's happening behind us at SIBO in Chicago makes sense. It's a marketplace that makes sense. There's a lot of people who own a lot of stock. It's worth them spending a couple basis points or, you know, a couple percentage points to insure that. And it makes sense for people to sell that insurance, right?
Yeah. I think there's a part of it that when you talk about it, when you make that point, and I look at the curve of what volumes looked like when we were all standing around in 2020 and looking at those volume numbers explode, and the case could very easily have been made that that $2,000 check that everyone got and the fact that there was a zero cost brokerage availability that was from their couch, that was essentially frictionless access to the market, was where that volume was coming from. And I think that is true. And then I also think that there is another story that is also true, which is kind of what you're saying, I think, is that you get this democratized access to everything. And then when you layer another layer on top of it and you teach people how these actual leveraged instruments work, what you end up with is someone who's stickier from a use case perspective. They end up, you know, like when someone logs on to Brent's webinar and learns how those flows work and learns the structural component of how that functions, it gives them a deeper understanding of what's happening behind the scenes. And what you end up with is someone who not only uses the product, but also understands just enough to want to know more. And that's kind of, right, like, that's how my options journey started, right? Is I walked onto the floor in 1998 and I learned just enough to be dangerous. And then I got put into a pit and started trading and I made a little bit of money and then I made a little bit more money and then I lost all of it. And then I made a little bit more money, right? And it was one of those situations where I learned just enough to be dangerous, but it also, I learned just enough to want to learn more. And so one of the conversations I had last year with someone was at the options industry conference that we sponsor every year. And they said something to me that was kind of revolutionary to the way I think about it, which is you spend all your time as a educator trying to teach people not to make the same mistakes that you made, but the retail user learns from doing. And so there's this weird kind of balance between how we think about it and in some ways how we teach it, but then the flip side of that is like, that's not exactly how I was taught how to do it. I was taught in the blacksmithing model where you just like the knowledge is handed down and then you like do it until you get your teeth kicked in and you're like, oh, I'm not going to do that anymore, right? Like that one hurt. And sometimes when I talk about options and I teach options, I always say the fact that the hardest, the things that I remember most about optionality are the things that cost me the most money when I did it the first time I did it, and I never forget them ever again. I'm not suggesting that we should just, like pull all the regulation on how we do this back. But I do think that there is this interplay between trying to make sure that people understand enough about it to want to learn more, but also giving them the freedom and the flexibility to actually do the things that they want to do. This is a perfect example of that, right? The interaction of like your LLM being able to connect directly to your brokerage account through some UI that just appears out of nowhere and then disappears after you're done. I mean, it's crazy, right? Like it's amazing.
Cool. It's a very cool idea to be able to, these certain types of trades exist. One of the reasons why I tell people, all right, when I speculate, I generally like to play cards. Options trading involves so much time, right? So just structuring, go find the strike, go find the company to do it on, go find the asset to do it on. When you've got the AI boost, I think it will take a lot of that labor out of the equation. Brent, on spot gamma, I want to come back to something Matt said, which is really important, which is structural flows. You had a great call on our show last week. I guess it was one of the first down days. You said, look, this looks like kind of just a structural thing that's part of the nature of the game of business now. When you have big institutions that have to hedge big positions, you can kind of see which days, in particular the down days, which is what I think is most relevant for most people. That's when they're paying attention to the market. They go, oh, why is my stuff down? You frame it as, hey, this looks like just a structural moment. Sure enough, we ripped back for a couple of days. Tell me about that kind of structural underpinning to options and how that is a main part of what you do at Spot Gamma to understand what's happening in the market, what's unique versus what's really, perhaps regime shift, which by definition doesn't usually happen, right?
Yeah, the breakdown in flows between, for example, what it means when someone sells a call versus buying a put matters, not just if we're trying to trade for ourselves, but also what the dealer kind of hedging impacts are of those flows. And also, are people, buying protection because they're worried about some future event, or do they think the market has tapped out and so they're going to sell calls? Because again, that's expressing two different views, and there's different flows that are associated with that. And then also, in this day and age, now we have 60% of SPX options are now zero DTE. That story's been told a lot, but that percentage of flow keeps increasing. So there are all these flows now that are high frequency flows, pod chop related quantitative flows that are, trading Tesla and NVIDIA options versus S&P options in dispersion type trading, for example. And so people will misconstrue the source of those flows and the intention of those flows as something that is always fundamental or always has a longer term signal, as opposed to, no, these people are just day trading essentially. And so by the end of the day, they'll forget about whatever took place today, and those flows don't have a persistent impact, for example. So the ability to sort of break down the end user and what their purpose is and what their aim is now has a tremendous impact on what exactly is happening. And if you think about the vol of vol in the current market, last August we had the VIX go to 60, right, on essentially nothing, right? No real event. This is when they blamed it on the Japanese, yen trade, and people forget that into that we had, the weakest breadth or smallest breadth ever, and that's when Jensen Huang was signing a woman's, it was like this fever, right? So you had this momentum go into that event. Well, volatility is mean reverting, right? So we crashed up and then we crashed down. And the reason I bring that up is because just this past January, China releases the DeepSeek model, right? NVIDIA has the largest single one-day drawdown in market cap terms ever. And that was just vested a few months later when Elon and Trump start bickering with each other on Twitter. Then Tesla loses 14% in a day, and that's the biggest market drawdown ever. So you see these events with increasing frequency now, these giant volatility events that are all a function of flows. And so the the reason I bring that up is back to the original point is that if you don't understand that it's these flows unwinding, then you sort of say, well, the DeepSeek news is the end of human civilization and AI as we know it. And it's like, no, it turns out everyone was just piled into 0DTE calls and they had to puke them. And then tomorrow we just go bounce back up. So you just see these things happen, all the time now. And and that, again, circles around to why not only do you want to understand what the flows are meaning, the best way to take advantage of those, but there's a ton of opportunity in that. If you know that vol is spiking because someone's, again, puking out a bunch of 0DT options, and that is a tremendous buy the dip opportunity, for example. And the best way to structure that in a fast market is to maybe just ask Claude the cheapest vol you can get, and then there's a platform to say buy this call spread. And you're like, great, I'm on off the races, right? So, this is the second derivative of the market. Not only understanding what the second derivative is in terms of impact, but also how am I trading the second derivative, which is really critical to understand now as well.
To that point, two things there that I think are really important. Firstly, the Japanese yen thing. It turns out that wasn't the end of the world. Like that. Do you guys know what 0DTEs are? When Brent says 0DTE, do you know what that is? Raise your hand if you know what that is. Okay, good, nice. All right, we're getting there. But it probably is worth pointing out, zero data expiry options are probably the best place to see where the second derivative and the second level of education is happening. So if you think about just buying a call or a put, you're speculating in a direction. But really what I think the second derivative options have brought to us is the time element. That's the best way to think about it, is you now have this third plane that you have to think about, which is time. Why do people like the 0DTEs, Brent? Is it just because they can see the time very clearly, the way it evaporates, day of?
I think the underpinning of it is that people think that in theory there's more time decay in a 0DT option, and then I think that is probably not necessarily true anymore. Matt, you probably opine on that as well, but there's a reflexivity to those flows. Like the more people trade it, the more other people want to trade it, right? And so when you're trading the 0DT options now, you have that time horizon that's obvious. It's a couple hours from now or a couple of minutes from now, whatever it may be. And so that invites a lot of selling strategies, automated type selling strategies. And again, they're reflexive in that everyone's doing it. Everyone appears to be making a lot of money doing it. And so, that begets the volume. But there's also fantastic trading opportunities embedded in there. If you think the market's going to rally a lot, you can either buy some shares or buy futures, or you can buy a very defined risk 0DT contract, and you know exactly what the P&L of that's going to be. It doesn't take a whole lot of intelligence to kind of figure that out, right? And then the other thing I would mention is that there's a tremendous amount of hedging utility in that. So if the market is down 3% today and you're a big fund and you don't want to sell your core put position, right, that doesn't expire for another 2 months, you can buy some 0DT calls or call spreads, right, and delta hedge essentially some of that intraday movement, right, which is, I think, also, really powerful utility. So again, 60% of S&P, I think upwards of 80% oftentimes now of NDX options flow is 0DT. And so that's a whole microcosm in and of itself. And just also on that point, if you're worried about what NVIDIA is going to report for next week for earnings or the government shutdown or whatever it is, those are all events that take place at some point in the future. That is, if you're a 0DT trader, what do you care? The market, your market, outlook is from now to the next hour or 2 hours, right?
It's a purist approach, right?
That's it. So you don't care about that risk, right? So it allows you to do all sorts of other things because the embedded risk in the market is some event that is weeks or months away. And so, there's a shorter term risk horizon that you're trying to manage, which I think is also attractive for some people.
Anthony, I'm sure you have an interesting perspective on, from the trading side on 0DTs. And when I think about why people like them, to Brent's point, is it eliminates things in the future. It's a pure way. I think also if we just think about generally trading this type of stuff, a lot of it is like surfing in a way. We're like, some days it's just not much. There's not much in the waves, right? But if we know, we can see when the waves are coming, that's when we can get a good surf. I'm curious, the tools you guys are developing, how will it help people understand 0DTEs or maybe become a better surfer in that water?
Yeah. I mean, I think surfing is a good analogy. I mean, at the end of the day, every wave you get on when you're surfing is different, right? And then when you're trading, every day is different too. You always have these different market things that are taking place. When you think about the technology that is helping you with whatever you're doing in your trading strategies, you have to think about how fast you can get the information in order to make decisions you need to make, right? So 0DTE, you need the information at lightning speed. So unless you're algo trading, or if you're program trading and whatnot, you need to either have your strategies in place and you're playing that same strategy every single day, or you need to have some fast source of information like Matt next to you all day long, feeding you what you need to be able to be doing because he knows everything about the options market. Well, I have Claude in my corner, and I'll be
calling him Cashman.
Cashman. We could call him Cashman. Yeah, my LLM would be Cashman. I'll have him in my corner right here, and I'll be able to communicate and actually have this conversation with them, what's going on in the market, what my risk tolerance is, and be able to quickly provide me what positions I can take with the risk parameters that fit my, style, and be able to pretty much follow the exact flows that are happening in the market that most traders don't have the knowledge that Brent has to really understand what's happening. So they're not even really making the right decisions necessarily. But the market is changing fast, right? And the information is changing fast. So if you have the tool that can provide you that information, education at lightning speed next to you within seconds, you're able to interact with the market. Now at TradeStation, I would say about 50% of our customers are 0DTE traders. So 0DTE traders. So essentially, we're seeing that same influx as well. They're expressing themselves in different ways, different instruments, but essentially they're in the market on a daily basis, directional, and trying to, express their ideas in a very short period of time.
It's been a short period of time, Matt. When we're talking about rails, should we talk about 24/7 trading, event contracts, futures? You guys, I think we can squeeze a 60-second closer thought.
Okay. You want me to talk about 24/7 trading and I'm not. Okay. Well, I want to say one thing. I do want to say one thing. And the 0DTE shift that we have seen and that everyone sees constantly, there is an element of it that I have kind of changed the way that I think about over the last, I would say, 6 months. One of them is because of the way that we're talking about the flows and the amount of flow that exists in that space, right? I think of it as a shortening of event horizon for everyone all the time in all aspects of our lives, right? Like Instagram is now 3 seconds, right? You're just constantly doom scrolling, whatever. But that happens in the options market as well. And when you talk about flows like that, and you see that amount of flow in the front of the curve, there is a structural element of it that I used to poo-poo that I don't necessarily anymore. And Brent and I have talked about this a lot. It's the idea of charm, which is delta decay. It's a kind of a sophisticated idea, but really what it is essentially the positioning of the people who are taking the other sides of many of these 0DTE trades. And because of the fact that they have to hedge on a minute-by-minute basis, they don't necessarily have the ability to not hedge. As a market maker, I was a market maker for a long time, you don't really, especially when you're trading that kind of volume, you don't necessarily have the ability to say, I'm not going to hedge these, right? Your book just hedges always. And so if you have all those people constantly hedging, and then the time coming out, which changes the delta of those options for all of those people in the same way, what you kind of end up with is some real measurable effects of charm, which is delta decay. And that's what, we've talked about this many times. We have both poo-pooed it and said everybody wants to talk about charm. It's not that big of a deal. But also have said, I don't know, maybe this is real. Maybe this is actually what's going on. So I think there's, as Brent was talking about, those educational opportunities, those trading opportunities, they do exist in there. But it's really important that people understand how the basics of the optionality work in order to understand how that situation is developing, right? I do want you to trust Brent. Brent knows what he's talking about those situations. I would even more like for you to understand how the actual contract works and then fact check Brent on his webinar when he tells you that something's about to happen, right?
Check with Claude too.
Yeah, all right, check Claude too, right? I mean, that's
There's
where
the reason you guys are all up here, right?
Yeah,
There's
exactly.
different forms of education and data. And I guess I'll close a little plug for spot gamma, because some of these terms, if you're thinking about second derivatives, you may or may not be familiar with. But we talk about gamma a lot. You guys have a tool coming out that's going to track Vanna, charm. All these things are getting more and more publicized. So it was a great conversation, guys. I think we're over. We got a question. Anybody? It's drinks time. I think bourbon, right? Bacon and bourbon. All right, beautiful. We got one back there. Yeah. That's a good question. Leverage in both forms, right?
Can I answer that? I think the single name equity ETFs that are levered, that are, obviously anytime that you're seeing something that involves leverage, they're using optionality in some form. I think that if you look under the hood in many of those situations, you need to be really specific and understand exactly what that thing costs you, because the leverage and the optionality never comes for free. And so from my perspective, when anyone asks me a question like that, my answer is always the same, which is go look at what they're charging you to get in and out. And anytime those people carry options, they have to roll them because, right, the underlying may not expire, but the options do. And if the ETF holder still holds that ETF position, the person who created it and gave it to them has to roll the options that are commensurately, right, the duration of your investment. And so they have to cross bid ask, they have to do all kinds of things, and they're probably charging you some amount of basis points in and out, which is not immaterial, right? And so that's kind of how I answer those questions. You can always do those things without paying the VIG in some ways. I hate to use that term, I'm sorry.
I mean, that's basically what it is, right? So do you want to pay someone to do the legwork for you?
Yeah, exactly, right? So that's kind of how I subset those two things in my mind from an options perspective.
It's like there's a new fund out, a double buffer fund from Innovator, and it's pretty creative because it basically is an effective short for like a retail trader. It's hard to short the market as a retail trader. To literally short it is quite expensive and difficult, and to buy puts, you got to time it basically. But you have funds that have their max payout at down 15%. So there's, you can pay. You're going to pay for that though. You're going to, but that's fine in some ways. In some places, it does make sense, to use those. But I think in terms of like speculation, if you want to speculate, you probably just go for the gold. You ever seen? There's a great old movie with Jack Lemmon about the two presidents. What is that movie? And he goes, he drops the F-bomb. His wife, he keeps like using he keeps saying fudge or something. She goes, baby, if you're going to drop the F-bomb, go for the gold. Like if you're going to speculate, go for the gold. Just do your damn self, basically. Any other cues? All right, Brent Kuchuba, Spock Gamma, Matt Cashman, OCC and OIC, Mr. Anthony Rousseau, Trade Station. Thank you.
Thank you.